There's been a lot of panic surrounding AI stocks recently, and much of that volatility can be traced back to Oracle. So last week, Oracle reported weaker than expected earnings, which caused the stock to drop by about 11%. Then the selling continued on Friday, when reports emerged that Oracle could face delays in delivering several new data centers for OpenAI, though Oracle later denied that there were delays. Then later, Oracle dropped another 5% after news that Blue Owl Capital had pulled out of a planned Michigan data center project. But once again, Oracle denied by saying that discussions around the project were still on track, even without Blue Owl's involvement. This series of events have not only caused Oracle to give up most of its gains since the start of the year, but have also affected quite a few AI names. For example, if we look at just the past 2 months, Oracle is down by almost 41%. CoreWeave has dropped by 54%. Both AMD and Nvidia have also dropped by 9%. Meanwhile, the S&P 500 be like meh, and is still up by around 1% over the same period. So clearly, a lot of this drop has to do with the AI-related stocks. So are we finally seeing the start of an AI bubble crash? Or is this all just a nothing burger? Let's find out in this video. Now, to be clear, the long-term earnings story for Oracle is still intact. Some analysts are projecting Oracle's earnings to shoot up by 2028 because revenue is expected to accelerate as its cloud infrastructure and AI workload volume scale. But before Oracle can get there, one of the most concerning things right now is how much debt the company is carrying. Oracle's debt to equity ratio is currently over 4 times. This puts Oracle worse than 97% of more than 2,000 companies in the software industry, which is extremely high for a large tech firm like Oracle. The credit market is also starting to reflect that concern. Oracle's bond yields have gone up and are currently trading more like a high-yield junk bond. So bond investors are now questioning whether Oracle's future cash flow will be sufficient to comfortably service its growing debt load while funding its aggressive AI expansion. So the question is, how widespread is this issue across AI companies? Thankfully, the answer is that this problem is largely specific to Oracle. If you look at a company like Google, its debt to equity ratio is only about 0.09, which is super low, and this reflects a balance sheet funded primarily by earnings and not leverage. Amazon and Meta tell a similar story. Even though they have massive AI and data center capital expenditure, both companies maintain relatively modest leverage levels and fund most of their expansion through operating cash flow rather than debt. This was also what Goldman Sachs said.
I think it's really important to think about where the funding is currently for the next couple of years. So if you think about the aggregate level of spend that we need probably over the next couple of years, we think it's about $700 billion to $1 trillion. And what should calm fears is that 90% of that is being funded by operating cash flows. It's really only 10% that's being funded by debt. And do you know that majority of that debt is actually going to be issued by Meta, which actually has a rating that's better than the US government, as the bonds are trading inside of US treasuries. So we're talking about CoreWeave, we're talking about Oracle, we're talking about 2 or 3% of the debt market of the entire funding picture. And so the vast majority is that the funding shape is actually in really, really good shape. It's just we're talking a little bit about the tails where there's a little bit of concern, right?
If we zoom out and look at big tech more broadly, the pattern becomes even more clear. Most mega-cap technology companies are generating large and growing net income, which gives them the ability to invest heavily into AI without meaningfully stressing their balance sheets. But more importantly, their price-to-earnings ratio remain far below the extremes that we have seen during past bubbles. Well, except for Palantir and Tesla, both of them are trading at around 300 to 400 PE. Meanwhile, Tesla's net income growth has been slowing down, while Palantir's current level of profitability still does not fully justify its valuation yet. Now, before the Tesla and Palantir bulls come after me with their pitchforks, let me be clear. I'm not saying that these companies are about to crash. Valuations can remain elevated for a very long time. And if Tesla and Palantir can continue to execute and deliver strong earnings growth, it is entirely possible that their fundamentals eventually grow into today's prices. Quick pause. If you are looking for the best brokers to kickstart your investing journey, check out Interactive Brokers. You will enjoy one of the lowest fees in the industry at just 35 cents per trade on the US stock market. It also offers Ireland domicile ETFs, perfect for saving on dividend withholding taxes. Plus, it also comes with free company research tools, so you can make smarter investing decisions. Feel free to use my Interactive Brokers link to open an account and start investing today. Alright, let's get back to the video. But this brings us to the next question. Where might the market potentially go from here? According to JP Morgan's 2026 Year-Ahead Investment Outlook report, it mentions that while valuations, earnings, and AI enthusiasm may look bubbly on the surface, much of the current market strength is still underpinned by solid fundamentals. Here, they pointed out that the Magnificent 7 earnings per share growth is expected to further accelerate to around 20%, while earnings growth for the remaining 493 companies in the S&P 500 is expected to slow down. This could be a good or bad thing, depending on how you look at it. On the positive side, it suggests that the largest AI-driven companies are still delivering real earnings growth and not just driven by narrative. These companies continue to benefit from scale, pricing power, and early monetization of AI, which supports their valuations far more than in past bubbles like .com, where earnings often fail to materialize. However, on the negative side, it also means that the market concentration risk will continue to be high. Right now, the top 10 names in the S&P 500 control almost 40% of the index, which means that these companies will be driving most of the earnings and index performance. And any stumble in the earnings will have a big impact on overall market returns. Meanwhile, Tom Lee, the perma bull, expects that there will be a possibility of a pullback early in the year as investors digest high starting valuations and slower economic momentum. However, he thinks the equity will be higher by the end of 2026, driven by the easing financial conditions and continued AI-driven productivity gains. And from today's levels, that will imply around 11.8% gains. JP Morgan also warns that while AI remains an important structural force, the biggest risk facing markets today is the elevated starting point for risk assets. And this is something that I've mentioned multiple times in the past. When valuations are high, the average returns that investors might see over the next few years will end up low. One viewer recently commented, "My personal view is that US tech stocks are at historical valuations and very high risk. I personally will not buy them until the tech bubble pops." Now, that is completely fair. It is your money, and how you allocate it is entirely up to you. But personally, I see things a little differently. First of all, while the US market, especially technology stocks, does look extremely expensive at today's levels, that conclusion can be misleading if we look at the valuation metrics alone. That's because companies today are far more profitable as compared to back then. For example, back in the 1990s, the S&P 500 companies had operating margins of around 5%. Today, it is closer to 13%. So when companies are far more profitable, it is natural for price to earnings ratio to sit at higher levels than in the past, as the growth and expectations today are far higher today. At the same time, the valuations of companies today are still more reasonable than the companies during the .com bubble, where at the time, many of them had little to no earnings. Again, of course, other than Tesla, which trades at a completely different stratosphere altogether. So while the market may look bubbly, a bubble does not burst simply because prices are high. In order for the bubble to pop, there needs to be a trigger, whether it's an economic shock, a collapse in earnings, or a sharp tightening in financial conditions. If none of those happens, the markets can remain elevated for much longer than most people expect. Historically, bull markets have lasted an average of around 5 years, and the current bull market is only about 3 years old. So if history is any indication, it would not be unusual for this rally to continue for a while longer. However, given that we can't predict the future, it is always wise to prepare for any downside risk, as there are always potential catalysts lurking in the background. Whether it is an unwind of the Japanese yen carry trade, a spike in margin debts which has historically caused the market to underperform in the short term, or something else. In my view, staying completely out of the market is a bad strategy, as the odds still favor markets moving higher over time. So sitting on the sidelines would risk missing large portions of the upside. So then, what can you invest in when everything looks so expensive? One interesting insight from JP Morgan is that while equity valuations are elevated across most markets, US equities remain the most expensive relative to history. This implies that opportunities may lie outside the US, where valuations are lower and earnings growth could catch up. This view is echoed by Charles Schwab, which notes that international earnings growth is expected to catch up with the S&P 500 over time. If that happens, global diversification could provide a meaningful source of returns. In fact, this year, almost every developed country has already outperformed the US, including Singapore. This whole saga reminds me of the late 1980s, when the Japan stock market was performing exceptionally well, to the point that it even surpassed the US stock market in terms of market capitalization and becoming the largest stock market in the world. At the peak of that optimism, Japan was seen as the future. Some even believed that the US needed to adopt Japanese corporate practices in order to stay competitive. And yet, after Japan's bubble burst, the Japanese equity market has still not recovered in real inflation-adjusted terms more than 35 years later. Now, I'm not asking you to avoid the US market altogether. The US remains home to some of the world's strongest and most innovative companies. But going all in on a single market, especially when valuations are elevated, can be a little risky. Instead, a far more practical approach is diversification. If an investor had diversified globally in the late 1980s, they would have avoided being completely caught out by Japan's collapse and would have done well over the next few decades. In short, what's happening right now is that there's a repricing in a market that started from very high valuations. Earnings are still growing, demand is still there, but given that the expectations are high now, the margin for error is much smaller. Trying to wait for a crash can mean missing further upside, while going all in on crowded trades increases risk. Instead, the more practical approach is to stay invested and diversified across markets. Anyway, that's all for this video. Hope you found this useful. Like, share and subscribe as I'll be posting new videos every week.